Let's get straight to the point. If you're a self-employed construction worker getting paid on a day rate, hourly rate, or even price work, and you're noticing that 20% is being knocked off your pay before it even touches your account, then yes, you're most likely being paid under the Construction Industry Scheme, or CIS. Now, what does that actually mean for you when it comes to getting a mortgage? Well, here's the good news, and it's big. From a mortgage perspective, that 20% tax deduction isn't just a detail on your payslip. It's actually a massive boost when it comes to working out how much you can borrow. And here's why. There are mortgage lenders out there who will use your gross income, that's right, your income, before the tax is taken off to assess your borrowing power. For the subbies who might have been a bit busy the day they taught gross versus net in maths class, that gross figure is your total earnings before the 20% CIS deduction is applied. Now think about that, because it's a game changer. Normally, when you're self-employed and applying for a mortgage, lenders want to see your net profit. That's the number that's left over after all of your expenses are taken out and your accountants had their way with it. But if you're being paid through the CIS, there are lenders who skip all of that, and they're not digging into your expenses, they're not analysing your tax returns, and they're not asking for 2 years of perfect profit figures. They just want to see your gross income, that top line number. And here's another bonus. Some of these lenders will look at just 3 months of CIS payslips to assess your income. Just 3 months, think of it. That means you don't need to wait until the end of the tax year. You don't need to prove 2 years of accounts. You don't need to get caught up in trying to explain to a lender why last year's numbers were a little bit lower than this year's, because they can take a 3-month average of your gross income and then use that to calculate what you can borrow on a mortgage. Now, let's not get carried away. There is a little bit of a common sense check built in here. You can't go from being a butcher or a baker or a barista to picking up a shovel 3 months ago and then expect that to fly. Lenders will want to see that you've been working in construction for a little bit longer, usually at least a year on the tools. But that can be a mix of fully employed work and self-employed work. It doesn't all have to be under CIS. But as long as you've got those 3 months of CIS income, a bit of history in the trade, you could be in a really solid position. So let's just recap what that means for you. You could be assessed on your gross income, not your net profit. You're not being penalised for having business expenses. You don't have to boost your profits artificially just to make the numbers work, which often leads to a nasty tax bill down the line. And you don't need to sit around waiting for 2 years of perfect tax returns before you can even start thinking about applying. If you're on the tools and being paid through CIS, this route could open the doors to borrowing more and potentially doing it sooner than you thought. So next time Gary at the pub starts telling you how hard it is to get a mortgage when you're self-employed, maybe just smile, nod, and remember, he probably hasn't seen a CIS payslip in his life.